Good afternoon, everyone. I'm Stuart Brodsky, and I'm the director of the Center for the Sustainable Built Environment at the Schack Institute of Real Estate. And I lead the development of the courses and the program content on sustainability at Schack. And I wanted to share with you my perspective, and this is perspective on the news and activity in the world of sustainability in the built environment as related to real estate. So that's the purpose of today's talk. So I'm going to give you a little bit of a preface, a cartoon. You know, we often start out with cartoons, and then provide some context, what I see as the global context for the development of sustainable real estate. I will talk about the promise of green buildings and how that's related to the context and the demand for sustainability in the real estate marketplace, and then talk about what I see as one of the key emerging and evolving topics, which is the demand for ESG, environmental social governance, performance metrics for not just real estate, but for all public-facing companies and organizations. And I will also look at some emerging products and practices in the world of sustainability in real estate, and then wrap up with some reflections on public policy and leadership, particularly in the United States. So the preface is this cartoon. You know, we thought that there was one proposal early on that as long as we clean our hands, we would avoid COVID. And now we know that not to be true, but we like simple solutions. And I think that's one point of this cartoon is we like simple solutions, but we also recognize that the threat of the disruption to the economy, to the world marketplace, was greater as a result of COVID, in response to COVID, than COVID might be in and of itself. That is an opinion that some people had. And those some people in this cartoon would also suggest that if we think that the disruption as the result of COVID is great, wait till we see the disruption associated with climate change. And I think that is a wise perspective to have. And it is a perspective I think that the world economic leaders have consistently expressed. At the World Economic Forum in Davos every year, participants in the forum participate in the Global Risk Perception Survey. And for years, they have said they have ranked the spread of infectious disease as a low likelihood, a relatively low likelihood, but a relatively high impact event in terms of the global economic impact. They have also at the same time recognized that a number of shocks to the economy that are associated with climate issues, such as biodiversity loss, energy price shocks, water crises, failure of climate change mitigation and adoption strategies, and large-scale involuntary migration and extreme weather events were often ranked far more likely and equally impactful as the potential for COVID-19, for a global economic pandemic. And so here we are in the United States in the waning days of our most recent round of concern over COVID-19, and yet in other regions of the world, South Africa, the economy is shutting down once again. Australia and other countries are seeing a third or a fourth wave as a result of the pandemic. And to again put this in the context of the world economic leaders, this might be a warm-up for what we will encounter as a result of climate issues. And I think that's a wise context in which to take seriously our challenges. The global context for the market for sustainable real estate development is, I think, an interesting one. I think this represents, or you can conclude from what I'm about to show you, that this is a good time to be, I'm sorry, hold on one second, is this the right presentation? Yes. This is a good time to be in the real estate development world. We have a current population of 7.5 to 8 billion people on the planet. with an anticipated increase of another 2 billion people on the planet by the year 2050. We need to build buildings to house and serve that population, in addition to which we've got about 2 billion people on the planet today who are inadequately served economically and by our buildings and building stock. So we have a lot of work to do and a lot of opportunity for real estate to respond to human needs. We must recognize, I think, that this need to address the human requirements does not come without an environmental burden. In the United States and elsewhere, about 40% of total energy consumption and greenhouse gas emissions is related to buildings, where about 28% of total greenhouse gas emissions and energy consumption is related to the operation of buildings, and about 11% of greenhouse gas emissions and energy consumption is related to the manufacture of materials that go into our buildings. Our buildings are also the site of a very significant portion of our water consumption and are the funnel through which we generate a tremendous amount of waste, whether it's construction and demolition waste to the tune of 9.6 pounds daily per capita, or our municipal solid waste. So buildings themselves and the occupancy and the patterns of behavior we have as a result of occupancy of buildings are highly related to an environmental impacts. And we can imagine or just visualize the environmental impact in this image from the manufacture of building materials such as steel. The population of the planet, as I said, is just over 7.5 billion people, and we anticipate another over 1 billion people on the planet by 2050, and another 500 million people on the planet by the year 2100. And we haven't been doing a good job, you might consider, providing populations around the world safe and healthy built environment without damaging the natural environment so far. And yet we have the challenge of addressing the needs of another 1.5 billion or 2 billion people on the planet over the next many decades. And the question is, how are we going to do that? The fact of the matter is, according to data from an organization called the New Carbon Architecture, or a book called the New Carbon Architecture, over the next 35 years, we can expect the real estate development world to be engaged in the development of another 2 trillion square feet of building stock. That's equivalent to adding 1 New York City to the planet every 35 days for the next 35 years. And the question is, how do we do that? And how do we do that recognizing the environmental impact that our buildings already have on the environment, where, again, 28% of energy consumption or CO2 emissions across the planet is associated with building operations, and another 11% is associated with manufacture of building materials, which makes the building sector at 39% of global greenhouse gases, a larger component or a larger portion of total greenhouse gas emissions than any other economic sector in the world. We often think of transportation as the major source of pollution because we see a tailpipe on every automobile, or most automobiles, except for the electric vehicles. But the fact of the matter is, our buildings, the tailpipes, if you will, of our buildings are emitting more pollution, more greenhouse gas emissions than the rest of the industrial sector or the rest of the transportation sector. So you can really look at the building stock and the stakeholders in the development of building stock as at the nexus of the conversation of addressing our climate challenge. And we are increasingly cognizant of the impacts of our climate challenge, whether it's the fires themselves or the toxic fumes that blanket cities like San Francisco last summer, or the floods in Louisiana that are occurring near industrial sites, where the flooding of the industrial site releases additional toxins into the environment. The fact of the matter is that the current concentrations of greenhouse gases, and I provide this to strengthen your vocabulary in this arena, the concentrations of greenhouse gases in the environment have typically fluctuated in roughly 150,000 year cycles. And in this bumpy horizontal red line, you see we peak and trough over the course of the past 800,000 years in terms of concentrations of greenhouse gases. But never have we had concentrations of greenhouse gases in this 800,000 year history as high as they are today. And this is coincident with the burning of fossil fuel from the development of the internal combustion engine, the beginning of the Industrial Revolution, and all of the burning of fossil fuel that we continue to complete. So before the Industrial Revolution, the concentration of greenhouse gases in the environment was around 280 parts per million. And as of 2015, when I first put together this slide, the concentrations of greenhouse gases in the environment were 392 parts per million. Scientists have said that we need to keep the concentrations of greenhouse gases below 445 parts per million, while when the economy is chugging along at the pace that it does typically chug along, we're adding 2 to 3 parts per million annually to concentrations of greenhouse gases to the environment. At that rate, as of 2015, we had between 17 and 26 years before we will exceed the tipping point. The tipping point being the 445 parts per million concentration of greenhouse gases. Well, as I said, I developed this slide in 2015. I updated this slide this past year. We are no longer at 392 parts per million. We are at 412 parts per million. We haven't reduced our global add, so we are still contributing or adding about 2 to 3 parts per million greenhouse gases to the environment. And remember, 40% of those greenhouse gases are associated with buildings, about 40%. So that means that we have new math. Instead of saying that we have between 17 and 26 years at current rates of emissions rates, we will exceed the tipping point. We now have new math. We need to recognize that within 11 to 16 years at current emissions rates, we will exceed the tipping point. So we want to ask ourselves, or we want to think about how our industry is poised and how we as individuals are poised to meet what is essentially an emergency. And one of the responses that we have popularly engaged in is the promise of, or the engagement in the conversation about green building. And I would say, however, that popular green building trends and resources are merely a starting point for the job ahead, and we have made a very, very minimal accomplishment across the building stock of building inventory across the country or across the world. We have seen significant, what seems to be significant market uptake of green building trends, but it's really only in very select markets. In the United States, I would say Class A urban downtown office space is very familiar with the green building programs, but that really truly represents a very small fraction of the total environmental footprint of our buildings. We have seen advancement towards significant achievement across some building inventories, across some market sectors, but in reality, given the entire building stock that we have, the current 2 trillion square feet of building stock we currently have on the planet, as well as the next 2 trillion that we can anticipate developing, we have not really done a very good job. I would say we are on a slow evolutionary process, and we need to be revolutionary. We have proven, however, that the deployment of the private sector, the supply chain, the promulgators of the value propositions, and the services associated with green buildings can be robust, but it is not nearly robust enough given the threat that we face. And I would say also that public policy is lacking the stimulus and the heft to move the private property markets so far. So we are seeing, as a result of this, I believe, a response by broader stakeholders than just the real estate industry itself. In particular, I see an increasing conversation about ESG and ESG practices in real estate in particular, as well as across all sectors of the economy. And the ESG conversation in real estate is coming from investors and capital sources, institutional real estate dollars, as well as occupants, particularly corporate stakeholders. The sources of capital are seeking ESG and have significant investment in real estate, where there is a major intersection with the E part of ESG, in environmental and social governance, and the environmental market therefore is being stimulated. The market of environmental issues in real estate is being stimulated to a greater degree than it was before. And publicly traded real estate funds, such as REITs, are particularly sensitive to this, as well as the S and the G metrics, which are evolving. And how meaningful the S and the G metrics are in the real estate industry, I think, is a question that we want to consider very seriously. I'm not sure the real estate owners and operators are the best mechanism for institutional real estate investors or institutional investors to stimulate the triggers for progress in the S and the G issues. The ESG metrics are evaluated by investors in order to identify superior management practices that might be aligned with premium or superior returns. But increasingly, ESG metrics are being looked at to figure out if companies that investors invest in lack demonstrable ESG practices, where the lack of demonstrable ESG practices can be a proxy for risk exposure and a threat to the downside risk and underperformance. And a lot of companies, there's been a lot of news in the past couple of years about companies whose reputations are tarnished by one thing or another, associated with their business practices, and that has a significant downside pressure on the value of these companies. And it is that same mechanism or that same path that I think we see in the questions that ESG investors are asking real estate. There is significant capital flows into sustainability funds, as well as significant capital flows in terms of investment in companies that are demonstrating their ESG performance independent of their being held by sustainability funds. Bloomberg Finance says that ESG assets under management could climb to more than a third of the projected $140 trillion of the global total institutional dollars and professionally managed assets by 2025. ESG assets are on track to reach $53 trillion, up from $37 trillion by year end. And they jumped to $30 trillion in 2018, from $22 trillion in 2016. So there is a significant amount of capital being placed in or being asked to evaluate or expected to evaluate companies that they invest in for ESG practices. The real estate industry has been responding robustly to this call for ESG, and among other things, I have seen a number of new hires in leadership positions at major institutional real estate investment holders. And these are just some of the companies that I know have been hiring sustainability professionals, people who have been in the sustainability world, in the environmental world, in the property management and energy efficiency world, and are now tasked with a broader umbrella of responsibilities for major institutional investors and asset managers in ESG. The National Association of Real Estate Investment Trusts has recently launched, as of 2020, an annual ESG report for the real estate industry, and is providing a lot of programming to their members to provide guidance on how the real estate world can respond to inquiry for demonstrative environmental stewardship, demonstrative social responsibility, and demonstrative good governance. And major REITs are producing reports such as this 40-page ESG report from Vornado. But what's interesting to me about this report, this ESG report, that's 40 pages, is that 20 of it is associated, it's 20 pages of the content address environmental issues, with wellness being part of environmental issues. BlackRock has committed to its $2.7 trillion in assets under management to ESG investing, and is rolling out a number of mechanisms and programs across all the assets they invest in, including the real estate assets, to evaluate and understand the risk that companies and assets hold or represent relative to ESG. And then there are real estate developers such as Jonathan Rose, who supports the development of S&G issues as well as E issues in real estate development, such as affordable housing development. And he recently closed a $525 million impact acquisition fund with investors, where the investors are so described as being entirely comfortable that Jonathan will produce superior financial returns, no sacrifice in financial returns, while also investing in assets and developing assets that address our social and governance challenges. There is an organization called GRESB that you might know of, the Global Real Estate Sustainability Benchmark. What you might not realize is that the organizations that stimulated and found GRESB include sovereign wealth funds and international public pension funds, such as the Dutch Public Employee Retirement System for teachers and government employees, called APG. And APG uses the GRESB survey and other mechanisms and queries the REITs that they invest in. And when you are a REIT and APG, which might be your 6th largest shareholder, holding 2.7% of your outstanding shares in Vornado, or 4.2% of the outstanding shares in Boston Properties, when your investor asks you to report on your ESG practices, you don't say why, you say, how soon do you want it? And what do you want us to do next? And this is slowly, I believe, moving the market, although it is not entirely clear to me that the investment groups, such as the pension funds, are making hard decisions to not invest in real estate companies due to lack of demonstrable ESG performance. Rather, they are holding the carrot out, or the stick out, saying we will not invest in you if you do not participate in ESG reporting practices. So I don't think they're excluding anyone from not investing in them, but they're encouraging more people, more real estate owners, to practice ESG by saying, if you are a candidate, you will be a candidate for our billions of dollars in assets under management as investors in your company, if you do participate in ESG practices and demonstrate them. The Oxford Real Estate, which is the real estate investment arm of the Ontario Municipal Employee Retirement System, invested $16 billion in Hudson Yards. OMERS, Ontario Municipal Employee Retirement System, is one of a number of pension funds that is committed to screening their investments for sustainability measures. I believe that Hudson Yards is not a particularly ambitious project when it comes to its sustainability accomplishments. It's certainly not bad, but it isn't groundbreaking. in terms of its sustainability accomplishments. But I believe that Oxford or our owners were to invest and consider investing with related in another Hudson Yards type project today, they would have a much more sophisticated and nuanced approach to expecting demonstrable sustainability improvements in their portfolio. CalPERS, California Public Employee Retirement System, and TIAA-CREF, two bellwether pension funds with billions of dollars, tens or hundreds of billions of dollars in real estate, have been asking the real estate companies they work with for years, what are you doing about your environmental practices? And they are now publicly stating they are extending that conversation to sustainability and governance, social and governance practices. So companies across all economic sectors are looking for ESG pathways. And that means also that real estate companies that find customers who are corporate real estate leaders attractive are also having to demonstrate their ESG practices to satisfy their corporate real estate customers. Among the types of projects that I see increasingly occurring is the pursuit of the purchase of renewable energy and the pursuit of carbon neutrality. Companies are pledging to carbon neutrality as much as they're pledging to anything else. So Amazon founded founded a commitment along with Global Optimism to call a call to action for companies to meet climate goals associated with the Paris Agreement by the year 2040. So these companies are all stating that they will pursue carbon neutrality, net zero carbon. And I think this focus on net zero carbon is a good focus. I think it's an appropriate focus. However, I think that the pursuit of the deployment of renewables in order to achieve that focus is not the right strategy going forward, because I think we need to be making our buildings more energy efficient first, because it's cheaper. And I don't know that we have enough resources on the planet to go to all renewable energy without other significant impacts. In terms of emerging products and practices in real estate, I see that one path going forward is the reduction in the carbon impact in real estate development. That pie chart that I showed you, where 11% of global greenhouse gas emissions is associated with the manufacture of materials that go into the building sector. I see an increasing use of building materials that are low in embodied energy and low in embodied carbon and high in embedded carbon. And my favorite, most exciting product along these lines is cross-laminated timber. This deploys the use of wood, which is grown in sustainable forestry methods, where the wood is processed in a way that results in a structurally superior or structural material that is as sound as steel or concrete, and therefore reduces the demand by the building sector, or has the potential to significantly reduce the demand by the building sector for the high CO2 building materials of concrete and steel. Cross-laminated timber and mass timber construction comes as a result of growing trees. A handful of trees, handful of seeds produces volumes of lumber, volumes of timber that can be processed and become lumber. And cross-laminated timber is large pieces of wood, perhaps 1x6 or 2x6, that are laid up like plywood in dimensions that are maybe 8 or 10 inches deep, 10 feet high, 10 feet wide, and 24 feet long. And these are structurally superior pieces of wood that are being used for mid-rise construction in a number of projects around the country and around the world, and are increasingly popular, increasingly demonstrated to be a viable product financially, as well as mechanically. And they develop some really pretty spaces that real estate developers are telling me people are very attracted to. They're commercial spaces with all this exposed wood Of course, these buildings have sprinkler systems in them, so they are largely fireproof, and the ratio of surface area of the wood to the volume of timber makes these very hard to ignite to begin with. So they're largely fire resistant to begin with. But of course, all of our buildings now, our bigger buildings, have sprinkler systems in them anyway. So this is a building that Hines, the real estate development company out of Houston, developed in Toronto. And this is a cross-laminated timber building, and it is one of many buildings that Hines is now developing. At the same time, the steel industry and the concrete industry are rushing to develop methods of manufacturing their product with a lower carbon footprint. The fact of the matter is that if concrete were its own country, if cement was its own country, it would be the third largest carbon dioxide emitter on the planet. So there's a lot of carbon emissions associated with concrete. There's a lot of carbon emissions we can avoid. The other step forward for building practitioners and building developers is to significantly reduce the carbon impacts from building operations. And I see energy efficiency as a high value proposition that is, I feel, taking a back seat to the attention that the energy efficiency professionals are being pulled toward to address the S and the G issues in the ESG. And also the energy issue is being addressed by the deployment of renewable energy, which again is far more expensive and far more impactful on the environment, such as solar and wind, than simply making our buildings more energy efficient. I work with my students on using the Energy Star resources such as Target Finder tool to help identify paths and the value proposition for reduced energy emissions, greenhouse gas emissions in the operation of buildings. Cross-laminated timber is, as I said, a sequestration, an embedded carbon material. It makes the building the carbon sink. But I also worry that when we're building cross-laminated timber buildings using curtain wall construction, we are missing an opportunity to significantly improve the thermal performance of the building envelope. And yet we know from the success of passive house certified buildings that we are seeing buildings that are nearly cost effective, nearly attractive to institutional investors to develop, that are having an 80 to 90% reduction in operational energy. So I see a rush to renewables and too little attention being paid to energy efficiency. The rush to renewables is extremely capital intensive, and the rush to renewables also results in the deployment of natural resources that that have an impact on the environment and have international trade implications, given where our solar panels, the material for our solar panels are coming from. So, reflections on public policy and leadership. The Climate Mobilization Act, New York City's Climate Mobilization Act, is described as the largest climate solution put forth by any city in the world. Well, New York being one of the largest cities in the world, if it has a comprehensive carbon solution practice for its real estate owners, then it would be a significant solution. However, I see that the Marquee program will not dramatically reduce the carbon impacts of New York City operations. It won't cut carbon emissions from the operation of buildings significantly or in a timely manner, given the number of years we have to reduce and cut our contribution of carbon dioxide emissions concentrations to the environment. So I think there's limited understanding behind the Climate Mobilization Act on the behavior of market participants. I did an analysis using the local law 97 energy carbon fine calculator produced by the Building Energy Exchange, and observed that for a 100,000 square foot building with a fine of $5,000 in 2024 annually through 2029, that comes to less than 5 cents per square foot. A fine of 5 cents per square foot, according to the professionals I work with from across the industry, is not going to incentivize investment in energy efficiency. The fine goes up to $1 per square foot, and then $2 per square foot in 2035. Again, I don't think the cost of investment in achieving these reductions in energy in fines is significant enough, or the cost of investment is so significant that the return on investment is not attractive. So I don't believe that the annual fines will incentivize improvement in the significant improvement in the efficiency of the New York City building stock. And if the New York City building, the New York City approach to greenhouse gas emissions is a marquee program across the planet, then I believe that we are in trouble when it comes to reducing our carbon impacts from our buildings. Similarly, the building energy performance certificate, which is now seen on or should be seen in the public lobby of every building over 25,000 square feet of space, I think it raises a conversation. I think it is a good thing to have, just as I think the fines are a good thing to have. But I don't think that alone or in combination with the other mechanisms currently in place, that they are going to incentivize the energy efficiency and the improved carbon performance to the extent that is necessary to respond to our climate emergency. Now, lastly, I wanted to comment on national leadership. Under the Biden administration, there's a lot more conversation and a lot more resources that are going to be discussed for addressing our environmental challenges. The infrastructure bill that was recently passed by Congress that Biden said he would sign is a phenomenal and a banner accomplishment, and will benefit the US economy very significantly. But most of the green infrastructure strategies and most of the green initiatives that the Biden administration has committed to are not part of this infrastructure bill. And so the deployment of programs that address our green initiatives are not yet funded. At the same time, the energy efficiency programs are being described as job generators. Programs like the Better Buildings Challenge and the Energy Star program, I believe they're being discussed as job generators, which is true. But I don't think the rates of improvement in energy efficiency are significant enough to meet our environmental challenges. And I also think that these programs are giving a lot of attention or a lot of focus from the administration to the renewables, which, as I say, are subject to international trade issues, which are sensitive to the sourcing of polysilicon from regions of the world where there might be trade embargoes due to questionable human rights practices by the governments and the companies that are employing the workers to mine and manufacture the polysilicon and the solar panels. So we have an environmental mandate, we have an environmental priority. It is one where we need to focus on carbon, which can be done through new construction practices by engaging in new materials like the cross-laminated timber and the mass timber construction. And we also need to focus on carbon through the operational efficiency of the existing building stock. And that is a conversation that has been going on for several decades now. And I don't think it is recognized for its importance or for its potential. And we need to recognize it for its potential in order to address our primary climate challenge, which is greenhouse gas emissions. We need to do this and balance our commitment to addressing other ESG issues but also recognize that I think some of the ESG issues, some of the S and the G issues are not necessarily inherently within the traditional scope of work of how corporations and real estate owners operate. And we will either need to expect companies and real estate owners to operate differently, or we will need to find the satisfaction of our S and G issues through other sectors of the market. So I think it is questionable why we have co-joined the ESG practices. And I think that the utility of doing so might be questionable, but is increasingly in demand. So I wouldn't discourage anyone from getting involved in that area, because I think that there's a lot of work and a lot of opportunity to be done. I think the public mandates and other market drivers are increasingly focused on carbon, such as the global cities programs, such as the green building certification programs like net zero, net zero energy, excuse me, and passive house. And we will see a lot more activity there, and a lot more opportunity to be involved. So I bring us back to the cartoon that I started with, and I'm realizing as I say this that I talked awfully fast. I spoke awfully fast. I'm sorry. I hope that wasn't too fast. I think in the context of our global challenge, our global priority, buying renewables sounds like a simple response, and it is equivalent to washing our hands to avoid COVID. It is equivalent to washing our hands to avoid COVID because it's not necessarily a bad idea, but it's not the best idea. It's not the most efficient, it's not the most comprehensive, and it's not the most effective idea. And we need to, as we identify the emerging strategies, the emerging use of new materials that are coming into the marketplace and that are being refined in the marketplace, we need to make sure that we are as effective and efficient as possible, given the limited time horizon that we have in order to avoid the climate disaster that is likely to occur in the early 2030s if we don't significantly reduce our annual contributions of concentrations of greenhouse gases to the environment. So as I said, I realized I spoke awfully fast. And I see a question or two in the chat box. I'm happy to respond to one or two of the questions that have already been posted, but I also encourage other members of the audience to submit questions. I will read the question that was already submitted and then discuss some of the other open questions. There was a question that, is there any data showing that real estate investors are willing to take a lower return or cash flow in exchange for more sustainable investments? And I would say not only isn't there any data that does so, but that the managers of investment in ESG assets are under the gun to make it very clear that there is no sacrifice in financial returns. Having said that, there are two ways of measuring or monitoring financial returns. There's the upside, and the idea that, for instance, a building that is energy efficient might have lower operating costs, and that might be higher net operating income, which would generate greater value. But there's also management of the downside, which is more intangible. And in that arena, you might say that buildings or assets that are managed through a rigorous ESG lens are likely to be more protected from a diminution in reputational value, which can be significant, but is hard to measure on individual incident by incident basis. So to conclude, no one involved in the ESG, or everyone involved in ESG, is out to prove that investment in ESG is a value add. And no one expects anyone to buy into investment in ESG at a sacrifice of financial returns. Another question that came up is, how does CLT pricing compare overall to steel and concrete buildings? And is CLT being used internationally, specific in Asia and Australia? CLT is more expensive than concrete and steel. The advantage that some real estate developers are leveraging to overcome the greater expense in concrete and steel is associated with the much faster assembly of the building. So in the real estate development process, when you're under construction and you're paying a high interest rate on your construction loan, if you can shorten, or every measure that you can take to shorten your construction period and accelerate your transition from your construction loan to your permanent loan, is a money saver. Another advantage of CLT is that pound for pound, it's structurally superior to steel or concrete. So if you are building a building that is on a concrete or steel foundation, you can design and build a lighter foundation, because the building on top of the foundation will also be lighter. So to ask on a per square foot or a linear foot basis how the pricing is of CLT compared to steel and concrete doesn't ask enough questions to allow you to recognize the superior financial opportunities associated with CLT. Another comment that I see here is there seems to be a lack of government incentives or tax benefits globally. Do you see ESG taking off globally without large implementation of these incentives? I think ESG is a market-driven conversation. It is being driven by the large public employee international pension funds, and the sovereign wealth funds that represent countries that have committed to the Sustainable Development Goals of the United Nations. And these investors are valued international institutional investors, and companies in the United States and elsewhere want these investors' dollars. And in order to attract or not be excluded from these investor dollars, the companies are becoming more articulate on their ESG practices. Another question, let me just read through this. This is a complicated one. Has NYU started to require that students model sustainability risk with each asset class? If not, how do you expect that how do you expect that to impact cap rates in the future when the large real estate private equity funds lose interest in those properties? Not exactly sure I understand how to answer the question. I do have my students model the financial impacts of energy efficiency and recognize that at a given cap rate, an energy efficient building can be valued at a premium. But I would say that also doing work with our investment management professors and looking at more ways of integrating the conversation into sustainability across our curriculum. So this question is well timed because it's part of an existing conversation, but I don't have an answer for you yet. Thank you for the question. Are there any other questions? I think there's another open question. Let me see, I scroll down. How can existing buildings become more sustainable? Can it be profitable? So in my experience, the average building can be 15 to 30% more energy efficient through practices that either have no premium investment cost or a premium investment cost that has a return on investment of one to 2 years. when you ask how a building can be more sustainable, I think the answer is energy efficiency. But there are other aspects of sustainability, such as recycling of the trash content of the building. And there are a lot of vendors of services, whether it's for recycling or for other practices that occur at the building site. There are a lot of vendors, there are a lot of consultants who are looking for customers among building owners to listen to their messages about how the services that these consulting firms can provide can generate positive returns, as well as address the environmental opportunities, the sustainability opportunities that the buildings represent. So not all aspects of what might be called green or sustainable always pencil out, but an increasing number of providers of services and vendors are very anxious to have your ear as a building owner and explain to you how their service or their product can contribute to sustainability. All right, I don't see any more questions. Does anyone else have another question? No? All right. My email address is S as in Stuart, B as in Brodsky, 4311 at nyu.edu. And I would be thrilled to hear from more of you on what you, thank you, James. You put my email address in the chat box. Be thrilled to hear more from you on what you're thirsty for, what your concerns are, and what additional programming we can provide. I am going to be doing some more talks in the fall, hopefully with leadership from the Biden administration. Well, not the leaders of the Biden administration, but the generals in the Biden administration, to talk about the programs that they are funding and supporting that address sustainability from the federal level. So that is one of the panels, or one of the panel conversations that I'll have in the fall, but we'll have others. And I'm very happy to hear from you as to what you're tackling with, what you're wrestling with, and how the center can provide you more resources other than those that are promulgated through the classes that we teach. So with that, I'd like to thank James Doolin, our manager, for administering this program. And I'd like to thank everyone who joined the call. And I wish you a very good day.